Hi guys, Kelly Provost with the Pros Real Estate Services, and I'm just going to discuss a topic that bears repeating. You're going to hear me talk about it a lot. You know, the elephant in the room, the elephant being this potential housing market crash that everybody keeps talking about. And yes, I know I've repeatedly made videos about this on Instagram, on Facebook. I make posts about it constantly. I want to be the expert delivering data-driven information to my clients and to my local market. And that's what's really important here. So I think that headlines do more terrifying than they do clarifying. I have some statistics here that were printed out that I can go over with you. And I would like to go over a recent study found on NerdWallet that says 67% of Americans say that the housing market is going to crash. That's 2 out of every 3 Americans believe that the housing market is going to crash. But if you're paying attention to the data, it's completely different. There are no factors for a housing crash in this current market. It doesn't mean that things can't change as we move forward, but the job of economists is to analyze the things that might cause any economic turmoil. And though there is some economic turmoil like inflation and other things, there are no factors for a housing market crash at this point in time. We pulled a couple headlines that actually talk about why 2/3 of Americans think that there is going to be a housing market crash. And let's see, we have headlines about foreclosure data. The U.S. foreclosure filing surged 115% in 2022. The U.S. foreclosure activity doubled annually, but still below pre-pandemic levels. And the foreclosure filings rose 115% in the past year. So though these are all factually true, they don't tell the whole story. Foreclosures have been significantly down, so significantly far down that when you actually look at what 115% increase is, it's really not even bringing you to any level that's close to a housing market crash. And that's what really needs to be understood. Let's talk about how the same specific headline is also not sharing information that's very relevant to the headline of foreclosures being up 115% from 2021 to 2022. This stat says right here that stats are actually down 34% from 2019. So that is before the pandemic shook up the market. So we had some things happening, and yes, I have seen some foreclosures, or I don't want to call them short sales because most of the sellers were able to get out with minimal equity, but situations where people did stop paying their mortgage because the government had given some programs that allowed homeowners to, if they lost their job due to the pandemic, to move their payments to the end and then refinance, and things happen and people can't always get out of these special programs. So what ends up happening is they need to sell the house, but there was equity. We have some charts here too that come in from KCM, which is a network that we watch for news and information on data. They're really good about sharing this, and I've got a lot of this information from them. And there's a couple of graphs here where I just want to put up on the screen. And I think the next graph that we have really shows this visually. So let's break it down. Take a look at the U.S. foreclosure activity. It doubled annually, but still below pre-pandemic levels. So look at the U.S. properties with foreclosures filings. It's going all the way back to 2005. And what you can see in those dark red bars is that those were the years where we had over 1 million foreclosure filings per year in this country. Now, it's important to note that in any real estate market, a crashing and increasing market, that there are always going to be some home foreclosures in that market. Things happen to people financially, loss of job, loss of income, loss of spouse. There are many factors that can cause a person to become falling behind on their mortgage, not reach for the help that may be out there, and get to a place where the bank is going to come and foreclose on that property. That happens in any market. So seeing a foreclosure market go up and down, that is normal, and it is part of any real estate market in the last 50 years. With that being said, we need to look at what the foreclosure information is telling us. So we had millions upon millions of foreclosures happening when the bubble bursts back in 2008 to 2010 period. Over 2020 to 2021 up to 2022, there was a 115% increase. As you're seeing, this is the frightening headline that is scaring people into thinking that there is some kind of market crash coming. But with that being said, that's only contextually 324,000 foreclosures, which is nowhere near the millions upon millions that we had when the bubble burst. Truth be told, the market right now is actually extremely low in inventory. I have been in real estate sales for over 10 years, and this is by far the lowest inventory that I have witnessed in my entire career. Now, in that 10 years, since 2011, I had also worked in real estate from 2005 to 2007, which was the bubble. And I can tell you from that experience that this market and the increasing market that we're in is not the same market that I experienced myself as a realtor, both from 2005 to 2007 and from 2011 till now. Let's talk quickly about what caused the previous foreclosure market. So these are the conversations that I'm having with my current clients who are nervous about purchasing a home as a home buyer, whether first-time home buyer or selling a home and buying another. They're concerned that they're going to pay too much money for a house. Why? Well, first, every property that I'm looking at and making offers on with my buyers is in multiple offers. My buyers are having to choose how high over the asking price, if the property is priced accordingly, they feel comfortable going. Now, most of these buyers are working with mortgages, so there is an appraisal process. That appraisal process is taking into consideration the last 6 months of sold comparatives on the market. Some appraisers will do a time adjustment, meaning if a similar home sold a year ago and they need to use it as a comparative property, they will give it a 1-year appreciation time adjustment on price, meaning the same house sold 1 year and 1 year later, it's going to be worth 10% more if appreciation is 10% higher. So with that being said, buyers have concerns that their offers that they're making are going to come in too high, and they're frightened that they're going to pay too much money for a house and that that house is going to lose the value. That is not what we're seeing based on this data here. If we look at this, now we did have the forbearance market of COVID when everybody lost their jobs or their jobs were put on pause for a while. And so the government came in with the program I discussed earlier to allow people to have more time to catch up on their mortgages or to sell the house if they could no longer afford it and get out of that mortgage. But there was equity, there was significant equity in those homes, which is different than when people started foreclosing because they could no longer afford the homes and inventory rapidly increased back in 2005 to 2010. We do not have that current issue. The issue we have right now is a lack of inventory for the size of the population in which we are in. So we are desperately in need of more listing inventory. We need more homes to sell on the market, and we do not have that. Fear is not helping this market, and I am trying to get my message out as much and as often as I can that fear is not based on data. I have a quote here from Bill McBride. He said, "The bottom line is there will be an increase in foreclosures over the next year from record level lows, but there will not be a huge wave of distress sales as happened in the following the housing bubble of 2005 to 2008. The distressed sales during the housing bust led to cascading price declines, and that will not happen this time." So this is what we're saying, this is what we're trying to say. And though the market fluctuates and more foreclosures will come in due to the forbearance and people losing their jobs and having to get new jobs or different jobs, having to change locations, there were people who bought homes during the pandemic because they thought that the ability to work from home was going to remain. And as we've seen over the last 12 months, a lot of companies are calling back employees because they found that productivity was down due to the work from home culture that was coming out of the pandemic. And so with that being said, a lot of companies are calling back employees. And so for those employees who moved too far away to commute back to their job because they thought they were going to be eternally able to work a telejob from home, they are now having to sell their properties and move. But there is equity in this market. So unless somebody did significantly overpay for a property, and in some cases that is happening, I am seeing buyers pay over appraised values for property. And if you pay over an appraised value for a property and the time does not catch up to the equity and the appreciation in that home, you're going to find yourself having to sell that home, most likely with agent commission, taxes, and additional fees to sell, putting you in a deficit on that property. But that's the short term, that's not the long term. I had a conversation with one of my buyers the other day because we were talking about the crash, and she was very worried that if she bought now and the market fell in a year or two, what would she do? And I reminded her that the value of your home does not matter unless you need to sell it. So for all of the homeowners who owned homes through the declining market in 2010, 2011, 2012, 2013, before we turned around and started coming back up in equity, the people who sold in those markets did lose money. Not everybody foreclosed. Some did, some were short sales, and some people paid the differences, and some people sold the house for what they bought it for in 2005 as the market started to come back. Somewhere around 2017, 2018, I would say we balanced out back to the prices of 2005, and since then we've appreciated significantly from there. So any of those people who held and stayed in their home for any extended period of time, they were able to ride out the crash of the market. And so I tell my buyers as we're working through this, find a home that you can live in over time, over 30 years, over 50 years, even over 20 years. You can ride out any market. The market is going to fluctuate. This is what economics and markets do. They go up and down. So even if we were to have a housing crash, you can ride it out as long as you can stay in your home until the market comes back. Take a look at housing prices from the 70s. My own parents bought a home for tens of thousands of dollars, tens of thousands. I think it was $18,000 back in 1975. That house has appreciated into the hundreds of thousands, if not $500,000 or more. So you can see over time how the housing is going to appreciate. And if you look at housing appreciation in the 30-year range, you're looking at anywhere from 4 to 7% appreciation year over year is a healthy average for home appreciation over a long period of time. We look at the last few years and we've seen home appreciation values anywhere from 9 to 15% year over year. That is very high. That is an extreme seller's market, and that is extreme appreciation. And we cannot continue to go in this direction. But the economy is showing us some inflation. That's going to dictate back to jobs and the strong economy that we're currently in. So it's all relative. So all we can do is see there is no housing market crash coming. Yes, the foreclosure market is up percentage-wise, but it was at an all-time low. So that increase, yes, it is due to some people finally needing to sell, some people taking advantage of the forbearances and not selling during that time when they should have. And again, we don't want to see anybody foreclosing on their home. If anybody is struggling to make mortgage payments, you probably do have equity in your home. So don't let the bank come take that house. Do not let a foreclosure agent from 5 years ago tell you should short sale your house. Give us a call. We will do a full market analysis and show you the equity that you have in that house, show you how to obtain that equity so that you can move to a more comfortable financial home that will allow you to live comfortably and stop worrying about potentially foreclosing on your home. So let us know if you need help. We did work through the previous foreclosure market and the short sale market, and we know how to help people with their home situations. Our goal would always be to help you stay in that house, and if there's any way we can help you do that, we absolutely would, as our first priority. With that being said, I do not see the housing market crashing. I would love to see a balance because I work with buyers as much as I work with sellers, and most of my sellers, well, they are buyers. And so this market is beneficial, extremely beneficial to sellers who don't have to buy, or buyers who can sell and use cash to purchase something without a mortgage. So with that being said, if you have a home to sell and nothing to buy, this is a fantastic time to sell your property. Again, it's still a fantastic time to sell if you're planning on selling over the next few years. I only see prices increasing and rates increasing. So this is probably the lowest rate and the lowest prices you're going to see in a very long time. I hope that clears some things up. And this is Kelly Provost with the Pros Real Estate Services. Over and out.